Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Markets have been consolidating ahead of the US CPI today. Now, the US CPI will give the Fed officials one more look at the inflation before their policy meeting. Currently, market is pricing a strong probability of a rate cut by 25 basis point in Fed's December meeting. Good morning, JK. Your thoughts ahead of the CPI? 25 basis point cut seems to be the base case. Do you think the Fed may adopt any other measures like reducing QT in its meeting?
Hey, good morning, Swaraj. Yes, the 25%, sorry, the 0.25% rate cut by Fed is seeing a probability of 90%. But I don't see a major shift in their stance or approach because they will wait for what eventual policies that come about in the Trump administration. So even the dot plot might be somewhat less aggressive as far as the rate cuts are concerned if you go by the individual member statements that we have heard in the recent days. So I think this Fed meeting would be one of the less eventful in terms of what's going to come later or even direction to the market. But staying with that, we are now actually in a period of watching inflation numbers. This week, particularly, as I said, the US inflation number will be out tonight. Expectation is for the year-on-year number to inch up to 2.7% from 2.6%. In fact, a month-on-month number is likely to stay at 0.3%, which is not so much of a comfort to the Fed. So that means inflation remains sticky, and even the stickiness of shelter inflation is also being observed, which is likely to keep further rate cuts in a question mark. So there is a lot of uncertainty as far as US monetary policy is concerned, based on even the inflation, not only the new government's policy as well. We had the European inflation, or rather the German inflation, on Monday, which confirmed the preliminary reading of higher year-on-year number. No, yesterday we had the Chinese inflation number, where the CPI headline and core both were much lower than expected. The PPI inflation also came much lower than expected, and that triggered more easing possibilities. In fact, in one of the most dovish statements for a long time, Chinese leaders signaled that they are ready to deploy whatever stimulus is needed to counter the impact of US trade tariffs. In fact, one of the key policy meetings is starting tomorrow, and we should be hearing what plans are ahead. Although markets so far disappointed with whatever they have been talking, but actual result that has been much less. So we will wait and see if they come out with something really substantial this time. Another central bank in focus is Japan, whose whose monetary policy is also concluding on 19th of this month. But the data leading up to this meeting has been quite hawkish, in the sense the GDP was revised upwards by the government. And then we also had the Tokyo region inflation earlier in the month, which came higher than expected. Expecting the overall country's inflation to be higher. And yesterday we saw the wholesale price inflation accelerated for the third straight month, as the companies were seen continuing to pass on the rising raw material costs, to the wholesalers. So this data comes ahead of the Japan meeting, which is scheduled next month. And I think while we have had contradictory statements from Japanese officials about what they are likely to do in this month, I still feel that conditions are ripe for them to hike a rate again, because we have seen wages rising, we have seen consumption also rising. There's very little justification for delaying a further rate cut and keep rate hike and keeping it at one of the lowest levels, which they will only be stoking higher inflation later if they don't act. The Japanese yen, of course, has weakened, having seen about 148 last month. We have seen it go up to 152 plus yesterday, but that is nothing to do with the monetary policy. I think this is more to do with one of the largest M&A deal that happened on the insurance sector, where a Japanese company bought insurance arm in US. The price touted to be at around $8 billion, and that was fully paid in cash. So the Japanese yen weakness was more related to the dollar demand because of that. But I think going ahead, we should see the dollar yen slip further as we head into the monetary policy meeting of Japan. Then we finally have the inflation number from India as well tomorrow, where the rather the year-on-year inflation is expected to come within the upper ceiling of the mandated inflation band, so at 5.5%. And this is the first number that Mr. Malhotra, as the new RBI governor, is going to face after he takes over, charge today. And yes, we will see if there are any specific reactions from the governor to these numbers, particularly if there is any major deviation. However, I think even at 5.5%, it does not warrant any quick action on the rates, because the earlier projection for the full year was at 4.5%, and we are at much higher level now. And the vegetable and food prices inflation volatility are contributing to these higher inflation numbers as well. So all in all, we are watching the numbers leading up to the policy meetings. Although RBI policy meeting is not there till the month of February. On the currency market, dollar is still hovering in ranges, and we don't have any trigger for a major move on the currencies. Which I think Fed, at least the Fed meeting, will be one reason where a market can see some directional trigger. But as I don't expect too much, triggers from the Fed meeting statements or from the dot plot, even that is not very likely. So we'll have to wait for some time until the new administration takes over in US. As for the rupee is concerned, continues to make new lows because of it's one-sided market because of the demand and supply situation, and market sentiment being quite bearish on the rupee in view of the persistent demand and lack of good supplies, and only RBI having to sell. And the more they sell, more dent on the reserves is seen, so that keeps the sentiment somewhat bearish on the rupee as well. So this is unlikely to change until we see any large inflows hitting the market, or we see turn in the dollar index overseas, and that is not likely to happen much sooner. So we need to keep watching the rupee and whether it continues to fall in a gradual way, or if there is the momentum to the move. Finally, in a relief to the global markets, I think US authorities, particularly Mr. Besant, who is the Treasury Secretary, incoming Treasury Secretary, has said that they are in agreement with Jay Powell continuing to serve his term. At least there is a no midterm change in the chairman of Fed, and the continuation of policy and approach should be expected in near term. Thank you.
Thank you, JK. And of course, markets would be gearing up for the US CPI, which will be out tonight. The expectation is of a year-on-year headline number to inch up, indicating inflation remaining sticky. Chinese inflation numbers released yesterday showed that CPI and core inflation both had come in much lower than expected, triggering more expectations of easing policies. Even the Chinese leaders, they have indicated that they are ready to counter any potential US tariffs with stimulus measures. Japanese central bank is also in focus because it has its meeting on the 19th, and markets may be expecting the BOJ to hike its rates. And data up till now has been quite hawkish because inflation and also wages has been moving higher, which is warranting another rate hike by the BOJ. Inflation from India will also be released tomorrow. It is expected at 5.5%, which is towards the upper band of the MPC mandate. And of course, this would be the first print under the new RBI governor. When it comes to currencies, dollar remained largely in range. No trigger yet for a major move. And for rupee, we continue to make new lows. Market sentiment seems to be quite bearish due to the persistent demand of the dollar and lack of any quality supply. Because we would want for some FII or FDI inflows for rupee to see some sort of relief from these moves. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.